Yeah, my financial advisor is 27 years old. He's out in Sacramento. He's the smartest guy I know. I mean, I've never met anybody like him. He manages their company totals like 9 billion. I think he manages like 1.5 personally. He's a money manager, and then my other buddy runs all the money for UT, which they have like 30 billion. And when you spend time with them, you understand that it's so much greater than you can even imagine. They're buying trees in the Amazon to supply multifamily. I mean, you just don't even understand the depths of how these numbers secular go down and down and down. And what he's taught me is that this world is literally one big transaction. And so, when they're lending out money to you, it's merely like they got the money at 6%. They're lending it to you for 9%. You're paying the points on the front end, so that's why they're getting their fee. And then they're giving their investors the 8%. It's like it just keeps going and going and going.
No, and I think that's been super apparent as everything basically came to a grinding halt. It became very apparent how reliant on all those cogs we are, that if one thing breaks down or multiple things break down, there's a trickle effect to everything else.
And we haven't even seen it yet. Like, because when you have an event like what you have in, like, okay, I'll just use what I know, Austin.
Sure.
South by Southwest brings in $400 million.
I know where you're going. Yep.
So what you don't understand, guys, is that the fucking city is going to have to find the money somewhere. And you know where that comes? Raising taxes. They're going to get their money. And so this is not, that one event getting canceled is a 5-year problem. It's not, that's what people don't understand.
Or it's just, removing expenses. So things they would have spent that money on are going to get cut, whether it's, other events, different public works, things like that. At least, unless I'm wrong, but I mean, you can.
No, I mean, and we just
increase your NOI two different ways,
either
raising extra income or lowering expenses. But no, it's 100%. And I mean, you've just seen it over and over again, different industries being affected that you wouldn't expect by things that are going on.
People don't talk about, because I spent 20 years in the restaurant business, high-end restaurants, bartending, chef. It's not the restaurant. Yeah, the restaurants are going to fail for sure. 40% of restaurants are going to fail, guaranteed. 30, 40, whatever.
Yeah.
But you're not even looking at the secular effect of the chicken farmer, of the distribution company, of the lettuce farmer. Like, I mean, it goes down.
I don't know if everybody's seen it, but you've seen reports of like people throwing out tons of crops, basically just they
that's what happened. That's what. So all my buddies work in oil and gas. All of them. They're all either on the hedge fund side or they work for a bank. Do you want to know why we're having a problem with gas right now? It's the stupidest reason in the world. We have nowhere to put the fucking gas.
Yeah.
Because nobody's been driving. They told me this 2 months ago. They said we can't make oil.
Yeah, it was like the future contracts it basically negative, so they were going to pay people to store them if you actually took it. But
I mean, they're like paying ranchers to like store them on their land. Like, this is for real, dude. Like, they have no room. Like,
no, it's crazy.
What a weird problem to have. Like,
it's absolutely crazy. And what I think is, where was I going? You started down the one path and it went off, and then you went back to gas oil. I lost it.
I can't help it.
But it'll hit me.
Yeah.
But no, I mean, it's, all the different things that are affected. It's mind blowing. Oh, where I was going to go with that is when you were talking about 30-40% of restaurants closing, what people don't realize is they think there was X amount of capital in circulation before this happened. But now what's going to happen is people that had, $1 million on the sideline ready for real estate, now they might take 200,000 to open up a business on the small side. So where everybody's thinking, like where a market's going to be in 6 to 12 months,
I don't know.
There's not going to be as much capital. So people's valuation of properties coming out of this could be vastly lower than they think. Because the whole argument was really interesting before this all happened. As they started doing what was happening was they were doing the interest rate hikes for a couple years, and what we could borrow commercial loans at was going up and up and up. Cap rates weren't really following it as much. So the spread was getting tighter and tighter between what you could borrow debt at and what cap rate you would buy at, which if you don't understand how that produces cash flow yet, go look it up or come talk to me and I'll explain it to you. But then what happened was obviously they stopped and then they started doing hikes and debt started coming down and then cap rates started coming down. So a lot of like a lot of major markets like your Raleighs, your Orlandos and stuff like that, you were seeing like 5% cap rates when interest rates were getting up into the high 4s and 5% range. They just started coming down into low 4s and high 3s for like a few months or several months. Cap rates started coming way down into the 4s.
Yeah.
And it was because people were, lenders were still making, as the treasuries came down, the lenders were able to borrow at 0.5% and lend it out at 3%. And you could then buy something for a 4.5 cap and make the spread over that. Like you were saying, everyone just borrows and takes a cut, basically. But what happened was, obviously, when this hit, transaction volume fell off a cliff because the debt world got way riskier. Interest rates came back up, even though treasury stayed, and a lot of lenders went away. The U.S. had to step into the secondary market to start buying bonds because the originators that originated the loan, all of a sudden they became more risky once Corona hit.
Yep. And
there was no secondary market. So that's why the U.S. stepped in and started buying bonds. And from my understanding, again, I have very limited. If you hear anything or somebody hears something wrong.
No, you're spot on. And so I want to tell you, because I literally lived it, so I can say firsthand, and
let me just finish my thought, and then I'll let you go.
Yeah.
So what a lot of people are talking about now is like, what's going to happen when the world opens back up? The treasury is probably not going to get hiked up right away. So where is lending going to be? Lending's probably going to be back in the high 3s, low 4% range, back where it was when interest rates, cap rates came down to these crazy low 4% ranges in these major markets, in these big properties. I'm not talking about your 10 unit in Tuscaloosa for an 8 cap, right? Let's call it what it is. So people are talking, well, cap rates will come right back down. I'll be able to sell it for what I was, but there's not going to be as much capital around. So if now all of a sudden I, as a buyer, have less competition, even though what would have sold for a 4.5 cap because interest rates are 3% 6 months ago, I have more to choose from now and I have less competition. So naturally, if everything was exactly the same beforehand, there's just going to be less capital in circulation because other things are going to need it and there's going to be other opportunities. People are just going to naturally pay less on a cap rate basis for it, assuming all that other trickle down stuff that you were talking about happens. Which
agreed. And the problem is because I lived it firsthand. The problem is not the first market, the traditional lending side. What people don't understand when you're inside the beast, and you're lending for new construction, development, hard money was what we did. The secondary markets are literally annihilated right now. I mean, like you're talking about, we went from doing 9 to 11% to it spiking to 2 points, 1 point, to going to 13 to 17% at 4 and 5 points.
Yeah.
Right. And I actually talked to my old boss yesterday. I don't need to talk about who they are. I'm not going to, but they had a really bad month. And like, when I say bad, I mean like off a cliff, down a hill, through the woods, like laid off, 40% of the staff. And they did that in the first week, bro. So like,
is that because of defaults?
Risky lend, maybe they had a little too much leverage out. But what happened was we get a lot of our capital from Blackstone and the bigger markets, and they just stopped lending money to secondary lenders, right? And so the money just went away. And
so if I'm understanding, basically because a large part of the business revenue is coming from the generation of these loans. Once that stopped, the revenue stream, right? Revenue stream for the company significantly decreased or stopped. So therefore, it couldn't afford the payroll. It couldn't
afford the payroll.
Gotcha.
But what you got to understand is this affects so many markets, like flipping and all these things. And so for me, that's why we launched the wholesale company on Monday, because for two reasons. I think there's going to be a huge need for it in the next 5 years. We're going to do a lot of owner financing sub 2 deals, but also I just want to keep the front of my funnel full so I can pick and choose my deals when I see fit. Right. And that's why we started it. And, we have a great team, and, my business partner's a freaking assassin. He's 22 years old. He's been running a brokerage since he was 18. He's great, right? And
Mhm.
I know nothing about wholesaling, nothing, but I'm sure going to
Awesome.
learn quick, And so what I'm saying, the reason I'm telling people that is you have to look at the market from a granular 5-year plan and go, what makes sense? And what Chris is saying is that, like, it's the truth, bro. I went to the best conference ever and they were over syndicating deals. There was 17 offers on one multifamily, all this stuff. So now, as a multifamily investor moving forward over the next couple of years, those 17 people, it's the same thing in the Airbnb space. 50% of my competition is gone. So if you can weather the storm, you're going to be able to buy a better deal. You're going to be able to move a little slower, make sure you pick the right deal, but you just got to keep your head on straight because you can't buy on emotion. What I try to tell young investors, it's the hardest thing for them to wrap their brain around. By you not buying a deal for the next 2 years, you might actually get ahead of everybody else.
Yeah.
That's true because you can't. One of my mentors is a massive developer. They do billions of dollars. He said you can't invest when the knife is falling directly at you.
No, that makes sense.
I mean, because the knife is falling, and here's the problem. So the market goes like this, right? You're falling, you're gap, and then you're up. People don't lose their shit when the market's coming down. They lose their shit when it plateaus. What I'm saying, they can't hold on because it's dropped so much. The money's got tight, the lending's got tight, and they're over leveraged. They can make money on the down and the up. It's that plateau before it kicks back up that's has people jumping off roofs.
Yeah, if the machine's not running.
Yeah, because we're getting ahead of ourselves. Everybody in life, they get ahead of themselves for everything. Oh, we'll just put leverage on it. Like, like what if you bought a 50 unit and you paid for it cash, right? I'm just saying, like, that's a hell of a deal instead of getting in 1,000 unit and being, doing it at 90%, right?
Yeah, I mean, I personally 2-3 years ago with Toro or eventually separating on myself was like, I want a $1 billion company that's, syndicates money and, we just own a ton of assets. I don't know if I don't know yet, but I'm not as certain that that's what I would want. And I wouldn't want like either just own a bunch of stuff by myself or with a few partners or with family or just like a smaller medium shop because you just have less headaches. And I think to your point earlier, people want to move too quick to get to where they are. I mean, it's 100%. If you're willing to, take 10 years to get to where you want to be, you'll go get 65% debt instead of 90. You'll go get 70%.
If you're building on legacy,
yeah,
and not units, then who cares how fast you get there?
Yeah. No, I mean, there are so many people that have 20 units that know more than I do. There's so many people that know, that own 100 units that know more than I do because they've been doing it longer and they've seen way more than I have. They're also in the weeds more. Like, I don't manage our properties. I've never replaced cabinets. I barely, like, that's another big flaw that I have that I don't really talk about. Like, I don't really know a lot. I'm learning because I always ask, and on due diligence, I'm always trying to be there when like the vendors are. But like the property, physical aspects of the property and like the stuff in it, I mean, I know next to nothing.
Yeah.
Like I know what I need to know to get a deal done because I rely on other people to do it because these properties support it. But I don't, I've never replaced a cabinet before. I've never fixed a boiler before. I've never fixed an AC condenser. You bought a single family home and you ran it yourself for 5 years. You know a heck of a lot more than I do in that space in that regard. And then over the next 15 years, you scale it up to 100 units. Now you got both sides of the coin. Yeah, you're in a way better position than me. I'm not saying you're going to be better than me at the same point in life because I think I'll probably work harder than a lot of people. But yeah, I mean, there's tons of people out there with a lower resume, lower experience, less units, less dollars on paper. You're better off listening to them than me.